It's no secret that the precious metals industry has been plagued by various manipulative practices, and it's crucial for us investors to stay informed and prepared. In this video, we are joined by renowned expert Andy Schectman, who will shed light on BRICS's scary warning about these manipulations and provide valuable insights on how to navigate this challenging environment. So stay tuned until the end of the video as we reveal what you need to know to safeguard your silver investments. Let's dive in! The recent inclusion of the Shanghai Cooperation Organization and the Eurasian Economic Union within the BRICS Alliance has set the stage for the transformative shift in the global economic landscape. This move signifies a monumental step towards challenging the traditional financial order and reshaping the dynamics of currency and trade relationships. The significance of SCO and EEU joining BRICS lies in their collective strength to counterbalance the influence of the US dollar, which has long held sway as the world's primary reserve currency. This expanded alliance, comprising BRICS nations, Brazil, Russia, India, China, and South Africa, along with SCO and EEU, forms a formidable economic bloc. While the initial focus might be on establishing a settlement currency, the implications are much broader. This alliance has the potential to reshape the global monetary system by introducing an alternative to the dollar-dominated framework, ushering in a new era of economic influence. The potential consequences of a reduced demand for the US dollar due to the currency diversification cannot be underestimated. As more nations opt for alternatives to the dollar, the value of the currency could decline, leading to inflation and fluctuations in interest rates. In light of these developments, Andy Schectman offers insights into the potential repercussions. He emphasizes the likelihood of increased inflation and interest rates as demand for the dollar dwindles. This situation could exacerbate by an oversupply of dollars, further eroding its value. Schectman's perspective prompts viewers to consider the implications for precious metals like silver, historically sought after as a safeguard against currency devaluation. Moreover, Schectman states that the imposition of US sanctions on Russia seems to have accelerated the nation's pursuit of a new world reserve currency backed, at least in part, by gold. This aspiration has led to the emergence of the BRICS group, consisting not only of the original BRICS nations but also dozens of others determined to break free from the dominance of the fiat dollar. This coalition is committed to establishing a transparent and gold-backed trading settlement system, which plans to unveil their first steps towards this goal at their August meeting in Johannesburg. Despite some skepticism surrounding these developments, the changing tides of international economic dynamics cannot be denied. The long-standing supremacy of the US dollar faces a formidable challenge as nations unite to explore the alternatives and pursue economic resilience. Critics who dismiss this shift fail to grasp the complexities of real economies, monetary theory, and the evolving landscape of global statesmanship. In recent times, the global financial landscape has been witnessing a seismic shift as countries like China strategically reduce their exposure to US stocks and bonds. The move reflects more than just a simple rebalancing of portfolios. It's a calculated response to the changing dynamics of the world economy. Amidst these developments, a potential transformation is looming, one that involves moving away from the reliance on dollar-dominated debt and towards alternative settlement currencies. The shift from holding significant amounts of US stocks and bonds to diversifying portfolios is motivated by the desire to reduce vulnerability to the dollar's fluctuations. Countries like China recognize that their dependence on the dollar puts them at the mercy of the US monetary policies and economic uncertainties. The strategic move allows these nations to better shield their economies from potential turbulence and exert greater control over their financial destinies. The transition could pave the way for a future where dollar status as the world's primary reserve currency is challenged. Andy Schectman's insights resonate strongly in this context. He asserts that the ongoing trend of countries diversifying away from the dollar is a negative sign for the dollar's future, irrespective of any recent announcements or a policy change. The writing on the wall suggests that the status quo is unsustainable and a reckoning could be on the horizon. Geopolitical events are inextricably linked with global economies, and recent developments have put the spotlight in the escalating US national debt. The exponential increase in the US national debt has raised concerns about its potential repercussions on the global economic landscape. A concept gaining attention is the idea that persistent inflation can be utilized as a tool to manage unsustainable debt levels. The logic behind this approach lies in the notion that by devaluing the currency over time, the real value of the debt decreases. This concept, while serving as a strategy to alleviate the burden of debt, also carries the potential to erode purchasing power. Andy Schectman brings to light an intriguing aspect of this scenario. The international community's recognition of the necessity of employing continuous inflation to tackle mounting debt. Over the past several decades, the world has operated within the framework of the dollar standard, which designates the US dollar as their predominant global reserve currency. However, Schectman contends that countries worldwide are aiming and coming to terms with the limitations of this system and are actively seeking alternatives to insulate themselves from potential vulnerabilities tied to a singular currency. In response to the evolving economic landscape, many nations are strategically orchestrating a gradual departure from the dollar standard. This transition involves diversifying their currency upholdings and exploring new settlement currencies. This calculated shift is motivated by the desire to reduce dependency on a single currency, mitigate the risk of economic shocks, and establish a more resilient economic architecture. The economic landscape is not without its storm clouds, of course, and one of the most concerning elements is the precarious state of financial markets. A significant risk lies in the current market situation, where overvaluation is rampant and driven by soaring valuations of just a handful of major companies. This concentration of value has led to the environment that many experts, including Andy Schectman, believe is unsustainable and potentially prone to a sharp correction. The decisions made by the Federal Reserve, the United States Central Bank, carry substantial implications for the stability of financial markets. The Federal Reserve's policy choices, including adjustments to interest rates and the implementation of quantitative easing measures, have a direct impact on market sentiment and stability. Schectman points out that the Federal Reserve's actions hold the power to either maintain relative calm in financial markets or trigger significant disruptions. These decisions must navigate the fine line between simulating and stimulating economic growth and maintaining market equilibrium. A notable development in the financial landscape is the US Treasury's reliance on short-term Treasury bills and the reverse repo market as a means to finance deficits. Schectman draws attention to the complexity of this maneuver, which not only impacts banking institutions, but also plays a role in managing the government's financial obligations. Reflecting on the insights of Austrian economies, Schectman references a prophetic principle that speaks to the eventual breakdown of monetary systems hinging on the continuous insurance of debt. This principle echoes the ideas of economists like Ludwig von Mises, highlighting the risks associated with relying on debt to cover government deficits. In the midst of the complex economic landscape, precious metals, especially silver, have captured the attention of many investors due to their historical role as a safe haven asset. However, the availability of precious metals is in the current market environment is a crucial consideration. Andy Schectman's observations shed light on this aspect, revealing that despite recent fluctuations in availability, the current conditions present a unique opportunity for those interested in accumulating precious metals. Silver, known for its dual role as both an industrial and investment metal, has experienced periods of increased demand, causing fluctuations in premiums and availability. Schectman's insights suggest that these market dynamics could influence decisions made by investors seeking to diversify their portfolios in uncertain times. Moving to Schectman's broader observations, a distinct contrast emerges between economic optimism and societal unrest. While economic indicators might offer a sense of positivity, societal divisions, shifting norms, and political tensions are reshaping the way individuals approach financial decisions. This intricate interplay between societal dynamics and the economic choices is a core facet of Schectman's analysis. He delves into how these social forces can steer investment behavior, redefining priorities, and prompting investors to reevaluate their financial strategies. The ripple effects extend beyond personal choices, influencing even commercial real estate markets and banking sectors. Schectman posits that the combined weight of these factors could potentially create pressures in commercial real estate, with potential implications for regional banks that hold significant real estate loans. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.